All right, so I've got 1 o'clock Central Time. It's 2 o'clock Eastern. Thanks for joining us for today's call, and Happy New Year to everybody. We're really excited about what this year is going to bring, and it's going to be interesting if nothing else. But as it relates to real estate, it's time to jump in. So this will be a slide heavy call. I did that on purpose. There's lots to cover, so let's see what we can do. So I wanted to start off with a little bit of perspective just about the market in general. I thought this was pretty interesting as we look at the top 10 stocks in the S&P 500. They're 800 times larger than the 75th percentile stock. That is a pretty astronomical type of number. And you can see it doesn't seem like that is going to stop anytime soon. As I look at it from another perspective, you can see that the tech stocks versus non-tech stocks is pretty significant as well. I think that's something to keep our eye on. What can this go on forever? Maybe. Things have been pretty flat for the year for non-tech, and tech keeps going up, especially since 2022. We'll see how that goes, but some pretty interesting perspective as we close out 2024 and head into 2025. As we think about interest rates and what the Fed policy might be, we can see that inflation, as we measure by CPI, PPI, PCE, that little arrow down here on the side shows that it's starting to peak up again. If we look at historically, once it starts going up, it kind of starts going up. We do see some dips in the short term here, whether that has to do with Fed fighting it or just general market malaise. Who knows? It's tough to tell on those things univariably, but as we can see, we're starting to see inflation rise again. So let's look at what the Fed funds have done. I'm a middle-aged guy here, and so my perspective on the markets is pretty much in a 20-year lane since I've started my career. But I always compare that to my dad, Mr. Poyer. He's 75 now, soon to be 76, and his perspective is a little different. So let's look at the Fed funds rate over 5 years. You can see we're pretty high and starting to come down a little bit. As we take a little bit broader look out 10 years back to 2015, you can see, we're still pretty high, relatively speaking, as it relates to Fed fund rates, although we're starting to come down. And we've seen in the past, historically, at least if we look at a 20-year number, what that means when we start to come down. All of a sudden, that the high number doesn't look as crazy 20 years ago, and nor does the trend. Looks kind of interesting on this Fed funds rate. And then if we go all the way back to 1954, we can see the Fed fund rate is really interesting from a historical perspective. So I think it's always good to look at history. Maybe it doesn't repeat itself, but maybe it rhymes. And looking at rates where we are, you can see once the Fed starts cutting rates, it's not likely, or historically maybe not likely, for them to immediately start increasing them or even stop decreasing them. But if we want to look at this, it's always good to compare the Fed fund rate to something. So let's compare it to the 10-year. I think this is something that we need to consider as well. You can see, the 10-year and the Fed fund rates, there's probably a little bit of correlation there. You can see some ups and downs and ebbs and flows, but I thought it might be worthwhile to dig into historical moves and how Fed fund rate has impacted the 10-year over time. Typically, when the Fed cuts rate, longer rates or the long end of the curve starts to come down. However, you can see a little bit of anomaly here. This this brown line right here is September 24 rate cuts. You see something a little bit different. It's starting to go up, which is kind of different from historical trends. If we pull that out and kind of isolate it, you can see right here, this line in the middle, our little vertical line. When the Fed starts cutting, you can see that the 10-year number has been going up, which is a little bit different than back here if we look again historical, where we've seen rates start to decline after the Fed cuts rates. So a little bit of a different starting point maybe from how the 10-year is performing, but let's go back a little bit further. So if I look at 1999 to 10,000, in June 30th, 1999, the Fed fund rate was 5%. By May 16th, 2000, the Fed fund rate went up to 650, peaked around maybe 660. I tried to pull out a quarter after the Fed stopped cutting rates. You can see what happened to the 10-year. Very interesting. If we take it from a starting point on the left-hand side and move it over to the right-hand side, kind of interesting how the 10-year changed. Here we see another rate cut in 2001 on January 31st. The Fed fund rate was 5.5%. By November 1st, 2001, we were down to 175. And you can again see, look what happened to the 10-year number. You know, it started around 5.5, 5.4, and it ended around 5.4. Let's go to the next one. 2006, we saw 2005, 2006, we saw a rate hike. June 30th, 2004, we were at a 1.25%. By the end of June 2006, we were up to 5.75 on the Fed's fund rate. And you can see what happened to the 10-year along that line as well. It started around 4.8%, a little maybe 4.5, 4.6%, and it finished around 4.7% right there. The rate cut of 2007, 2008, we started in September, middle of September 2007 at 4.75%, and we got down to 2% at the end of April 2008. You can see how the 10-year number performed there. It started around a little over 4.5. It got down to 3.85 at the end of that period. Again, looking a quarter after the Fed stopped cutting rates. Let's look at the rate cut of 2008. You can see in middle of October 2008, we're about 1.5%. And by the end of December, we were at about 25, or basically zero. 10 years reaction is there in the black line. Rate hike from 2015 to 18th. You can see we started December 2015 around 25, 50 basis point range. By the end of December 2018, the range was around 250 basis points. You can see how the 10-year responded there. It started around 2.4%, ended around 2.4%. A couple more because this is fun. Rate cut of 2019. We started in August around 2%, ended in October around 1.5%. You can see the 10-year kind of ups and down, ended kind of about the same point at 1.92%. And then the 2020 Fed cuts, we started in March around 0%. Middle of March, just 2 weeks later at 1.25%. We moved from 1 down to 0.6% in the 10-year. And then the last one here, this 2022-24 rate hike. March, we were at about 25 basis points, March 2022. And then September 2024, we got up to about 5%. And you can see this actually caused a pretty significant increase in the 10-year over time. So as we kind of go through the Fed cutting, you can see its influence on the 10-year. Maybe in short term, you see some fluctuations, but over the long term, it's kind of interesting to see how the 10-year responds to these Fed rate cuts historically. Maybe not as much as you think, maybe in different directions than you think, but it makes me go back to that initial slide that got us in this conversation, you know, to see that in this period of time, the Fed has started to cut and the 10-year has gone up significantly. So the million-dollar question, what does that mean for mortgage rates? You know, I looked this morning, I go to the mortgage calculator, kind of it's a more wonky one than you'd find at your bank, what mortgage rates are, but we're up to 7.14% for a 30-year fixed mortgage today, 15 years at about 6.5%. If we look at that over the past, couple of years here, you can see this is probably your more street level, 6.9%. This is at the start of the year, early January, about 6.91%. I always like to think of what's the spread between mortgage rates and the 10-year, but you can see we can go up, and is there any stopping it going up is the question. Here's the spread as you look at it, mortgage rates and the 10-year over a 5-year period. Today, our spread's about 2.3. Historically, that spread's been about 1.5 to 2%. So we're on the high side here, but you can see that it's starting to move up and move up even more. And that spread is starting to widen a little bit too between the 30 and the 10-year. And I want to just kind of chart it out a little bit more since January 1st, 2000. Well, what a wild ride it's been. We started a little over 8%. We went down to, a little under 3%, if you remember those days. And now we're back into 7. Maybe we get back up to 8%. It's not out of the question by any means. And so that's going to have significant impact on the housing market on both sides. If you own your home, well, it's pretty interesting. If you own a mortgage, you're locked into a mortgage, you still have 15, 20, 25 years in that mortgage. So it's pretty good. If you're looking to get a new home, That's a little bit more difficult. Here's one more look at that spread. The orange line is the movement of the 30-year. Its index is here on the right-hand side. The left-hand side of the graph here, this vertical one, this is actually the 10-year. It's a little bit wonky graph, but I like how it shows the spread over time. So let's go into the home price appreciation and talk about real estate a little bit more, because this is really interesting. Historically, the average has been about 4%. If you go back to like 1950 or around then, you can see historically it's moved straight up, basically 4% a year. There's only been 2 down years outside of 2008 in the housing market. It looks like we're going to be back around, that historical average. Forecasts are showing that, yeah, maybe we dipped into the 2.5% appreciation, but going forward, anticipation is to get back to 4%. You can see the sales price, or the average sales price, is right around 400,000. We'll go into more detail there. Here you can see another, that 4 to 7% annualized growth. This chart's kind of looking at the ups and downs of the last few years. A lot of that is in reflection to interest rates and what happened with interest rates and things moving. What I like to look at, sweet little Omaha, Nebraska, home price appreciation, 5% right there in the middle of the curve. You can see home price appreciation between October 2023 and 24, how it's changed in your state. But it's kind of interesting, the forecasts be pretty similar going forward. You see some locales, especially the Sun Belt in Texas, Arizona, Colorado, we're back to levels before the pandemic in terms of availability of homes and of listings and such. We'll show that in a moment. But the growth in home prices is kind of an interesting metric to keep on. Whether that's sustainable or how that impacts the economy is very interesting. Inventory, because we want to know like what's going on out there. We can see the inventory keeps kind of coming down. The inventory that moves the market and that's most interesting to us is not new builds, it's people moving out of existing homes. We've seen that levels be historically low over the last couple of years. As you'd expect, people who are locked in a 3% mortgage, the odds of them moving to an 8% mortgage are very low. So people continue to hold on to those. And so there's not a lot of existing home inventory, but the builders are building. New home inventory has been growing. The forecasts are kind of to be consistent with the counts going forward. You can see active listings over the past 8 years or so. We're right in the middle. The brown line there in the middle is showing how our listings compare to previous years. So not the worst on record, definitely improving over 2021, 22, and 23, which is good, but still below pre-COVID era type of housing listings. And the same is true, although if you kind of look here, newly listed, the number of new listings is lower than it's been in previous years heading into December. Only 2022 and 2023 were worse. We're right in line with the last couple of years in terms of newly listed houses. And on the other end, the number of days on the market is starting to creep up again. We peaked in May in terms of the fewest days, or the median days of market. Now we're creeping back up again to that 70 days on market, which means that it's not moving like it was in the COVID era in the 2021 days. We're kind of stuck with these homes being listed, and a lot of these are being taken off of listings rather than being sold. This is the big one though, housing affordability. Let's compare 2021 to 2025. Man, you can see the growth in home prices. We went from 346 to 405, but look at what happens with interest rates. We're going from an interest rate of 1,300 to an interest rate of 20, or a monthly payment of 2,400. That's almost doubling your principal and interest payments over the life of a 30-year mortgage. I mean, it's hard to understand. It's hard to see how that's sustainable. But on the other hand, it's if you're in your home and you are keeping up with your payments, man, that's the last thing you're going to default on. That's the last thing you're going to give back to the bank. It's almost, I think we've said this before, but when I talked to my dad, the balance sheet in the 1980s, your house was your asset, your liability was your mortgage payment. Today, it seems like your liability is your house and the things that could go wrong with it, especially as insurance costs go up. Your asset is 100% that mortgage. If you're locked in at 3%, your home price appreciation is going up 4% a year. It's maybe gone up 30, 40% over the last few years. That is an asset, and that's an asset with great collateral, so to speak, for investors or investing. Here's another way to look at the mortgage payment cost of buying a house over the years. You can just see it skyrocketing. feel bad for people who are just getting started or having to move and that sort of thing. It's going to be a rough slide for them. The forecast for affordability, Dave Ramsey rolling in is probably not too happy about this, but we're well over the 24% and the 30% of your monthly income is spent on a home purchase. Rents are going up. We won't talk about that here, but your mortgage payments were well above 25%. Refinancing just not happening, right? We saw a little blurb or a blip in 2022 and even part of 2024 when rates came to about 6.1 in June, but that has really dried up. You can see right here, that little blip, that was when we saw rates at 6.1. There was a little bit of refinancing, but if we zoom in, we can see that, man, those are still a lot lower than historical averages. There's no incentive to refinancing. That plays havoc with banks, lenders, and other side of the deal as well. And you can see here's another thing, people are dying to refinance. Even when rates got down to 6.1, people were ready to refinance. And so you saw those click up in June. It won't take much for that to happen, but it's still a long way off. And this is the money, this is the one from an investment standpoint, or even from a homeowner standpoint, continues to stand out. You compare the average American's existing mortgage versus a new mortgage, you're looking at a spread of almost 3%. And from a monthly payment standpoint, we already talked about the breadth that represents. No one's walking away from that mortgage. It's such a valuable entity, and you consider that the value of the homes is going up at the same time. It's really interesting. I love this graph where you can kind of see the interest rate outstanding on mortgages, and you can see it's peaking up a little bit. The growth, if you look down in the corner, the percentage of people with mortgages above 6% into the 7 range is growing, but it's still pretty small relative to this 3 to 5% range, and especially this 3 to 4% range right here. Again, those people have a valuable asset. So let's look forward a little bit. Realtor.com is a good one. It's an easy one to look at. I'm sure there's a million different perspectives. I like this one because it's kind of where the rubber meets the road. It's the realtor world. They're guessing by the end of the year we'll see rates at 6.2. If we saw June this year when we saw a blip in refinancing, that could kick some refinances, which might be good and interesting, but that's only for newly issued mortgages. That's not going to be for your more, I guess, seasoned being 5 years older now. Good home price appreciation, sales starting to creep up a little bit. It's not great, but we're still 1,025,000 homes off the historical average. But growing, which is kind of nice. Existing home inventory creeping up, which is kind of good. That's kind of seems like people throwing up their hands. There's nothing else to do. This is the new normal. And then you can see home ownership rate is above the historical average. People are holding on to stuff. I would assume that's, baby boomers, retirees saying, I'll just keep my house rather than downsize. Downsizing is, you might downsize from size, but your monthly payment could go up. So you're not going to see a lot of that happening here in the short term. So a lot of perspective there. I want to end there, keep this at 15 minutes and respect your time. But from an investor standpoint, man, it looks like existing home inventory is a valuable asset and valuable collateral per se. Investing in new real estate, we'll see what that means. We'll see what happens to rates. But all in all, this sector is really fascinating. There's little pockets here and there to definitely take advantage of. I think in the next couple months, we'll start talking about commercial because that's getting super fun. But thanks for joining us today. You'll see a poll on your slide here if you want to learn more. Set up a call with me or one of the portfolio managers for a couple of real estate oriented funds. We're happy to make that happen. So thanks so much for your time, everybody. Happy New Year. Here's to a great 2025, and we'll talk to you again next month. Have a great day, everyone. Thank you.